in America, there's a saying, if you can't afford it, finance it. There are signs everywhere showing us that our economy in the US is going downhill, and is going downhill fast. One of the things that gets measured is total household debt, also the housing debt. And right now we're gonna go over a few stats that I'm seeing that are not pointing to the right direction. You see, total household debt went up once again, over $184 billion, billion with a B. This is unbelievable. This means that the consumers out there have increased the debt that we all carry and that is being funded by banks, basically, to over $184 billion from quarter to quarter. This is from the fourth quarter 2023 to the first quarter 2024. And do you know how much money right now is owed? $17.69 trillion. This is crazy. This is showing me that people are not spending properly. People are spending money they don't have. That's why we have debt. That's what debt is. Somebody has lent this money and now this money is owed. This is not a safe thing to do. This is a bad habit. And you know, obviously in America, there's a saying, if you can't afford it, finance it. In that same time period, the mortgage debt increased by over $190 billion to over $12.44 trillion. These are staggering numbers. And of course, the majority of the debt that is held by consumers is within mortgages, because that is the largest purchase that we all make. And what's the second largest purchase we make? Automobiles. So auto loans climbed over $9 billion in one quarter, and now it's over $1.62 trillion in auto loans. And all would be fine and dandy if people were paying on it, but unfortunately we have record high delinquencies. But before we get into delinquencies, let's address the third biggest problem, which are credit card debt. And in the first quarter of 2024, credit card debt is at over $1.12 trillion. They should really just let people fall. You know, we always have these bank bailouts, and we always have these programs that come and save the day when people make dumb mistakes, which is borrowing too much money. That's all that means. But unfortunately, they're not doing anything to let people fall. I don't know what you think, but I think that if we had like a big, great reset, then that might actually help people, because usually when we have a giant collapse in an economic system, then new rules get implemented that are stricter. And then as things go well, those rules start getting unwound, and then eventually things get pretty loose. Like for example, in the Great Recession of 2007, 8, 9, 10 and all that, they had made new laws for lending guidelines for mortgages. And that really helped, because before that, it was kind of unregulated. There was some regulation, but it was very much unregulated compared to today. But we still have a lot of regulations that got removed. And of course, what happens from that is people who aren't supposed to be getting loans get loans. They have no business in qualifying for a loan. I know people who definitely came to me and were qualified, and I'm like, don't do it. You are like 59% of your debt to income ratio after you buy a house. Don't do it. Don't buy a house. Get your debt under control first, increase your wages, how much money you're making, and then recalculate your debt to income ratio, and then buy something when you can be under 40%. Like, look at this chart right here I'm putting up on the screen. This chart shows how it's been growing and growing and growing, and at the bottom in the blue is everything for households, you know, for household debt, meaning, home debt, basically mortgages. Everything above it are like the car loans, the credit card debts, everything like that. And as you can tell, it's pretty much been a straight ride up. More and more debt every single quarter. And there's been a couple of dips, and that was the Great Recession. But as you can tell, during the Great Recession, it didn't fall much. It's almost like we need a Great Depression, which we've already had a Great Depression about 100 years ago. So maybe we can call it the new Great Depression or something else. So now let's talk about our default rates, because this is going to show us if people are able to keep up with the debt they ended up taking. Default rates usually are pretty low, but right now we are at a 10-year high for credit card default rates. That means you didn't make your payment on your credit card debt. Okay, that's what that means. That's what a default means, is that you have defaulted on the agreed upon terms. Now, seriously delinquent means that it's been 3 months, 90 days of non-payment or late payment or defaulting, basically. And right now we're at 10.7% of all credit card debt that is in serious delinquency. So out of that $1.12 trillion, let's just say everyone has the same amount of balance. 10.7% of that money, over $100 billion, is currently in default. I should say in serious default, serious delinquency. Most people that fall into serious delinquency do not find a way out. They unfortunately just get totally closed out. You know, they close their accounts, their credit score goes down. They can't get credit cards because obviously they're not trustworthy borrowers to repay the debt that they took. And you can prevent yourself from falling into that by just never borrowing money in the first place. This is the American way, but you don't need to do this traditional route. You don't need to go and borrow money for everything. Just live cash, like live on a cash basis. Can you do that? Try it. I dare you to try it. I remember there was probably a decade where I was going the cash basis system, meaning I had the envelopes, literally, I had the envelopes. This is just like 10, 12 years ago. I had envelopes set up, I'd get paid, I'd take cash from the bank and I would put everything into envelopes, you know, my taxes for my property, because I had no mortgage at the time, went into an envelope. Then my food budget went to another envelope. My car insurance went to another envelope. Even though I was paying once a year, I was just saving. It was like my own little escrow account. And do it, try it. It was such a good system. I don't know why I stopped, because it was such a good system. You know, there is a saying which says, what gets measured gets managed. And think about it with money, with your finances. If you start measuring every single dollar you have, then you're going to manage it a lot better. You're going to know what's going on with all your money that you're making, or what's going on with your spending habits, or maybe what's going on with paying down the debt. You're going to have so much more control over everything. And the thing that's going to make it a lot easier is if you get an accountability partner. Get someone else to help you out to do this, you know, budgeting with you. Someone who's maybe also is in trouble and wants to have their own accountability partner. Someone who wants to say, hey, how did you do today? How did you do? Did you pay anything down? Did you accrue more debt? Like, that's what accountability partners do, is they keep you accountable to what your goals are. Now, not everyone's gonna have the same goals, and you don't need to have the same goals as your accountability partner. You just need to have someone that you can talk to on a daily, weekly, monthly basis. You know, the more you talk to them, the better it'll end up being, where you're not gonna go and take on more debt, and you can go and start paying things off. The first thing to debt reduction is to stop using debt. Stop using the credit cards. Start using the cash that you have. That's the first step. So I'm telling you, if you have a problem or if you have a situation that you want to get out of, stop using debt. Go all cash. The easy way is literally cash, like cash in your pocket. So if you want a Starbucks, it's got to be cash that's in your pocket. And keep the receipt too, so that you can be accountable to your spending habits. And by the way, credit card default rates, the serious delinquencies, were only at 8.2% right around a year ago today. So as you can tell, 2023 to beginning of 2024 has had a step in the wrong direction for the general American population for not being able to pay their bills on time. Now, as we get more and more jobs reports, we'll see if people are losing their jobs, which is a key indicator on whether or not people are going to start falling behind. So as we see jobs reports be bad, then we're going to have more and more of these delinquencies start happening. And eventually, after, you know, your consumer debt doesn't get paid, eventually some people, they stop paying on their mortgage. So then we have mortgage delinquencies. But before that, usually the mortgage is the last thing to go. Usually the first thing to go is credit card debt, then auto debt, because people still need a car to get to work, and then a home debt. But since this is Florida Real Estate TV, let's talk about real estate just a little bit, because we have made it on the map. By the way, right now I am in Sarasota, Florida. This is South Lido Park. I'm just taking a nice stroll here. It is weekend. There's no parking. I did find a spot, but it took me 30 minutes to find one, and it is so busy, so beautiful. Hot day, about 90 degrees right now. I'm a real estate agent. If you want to buy anything, if you have any questions about real estate, you can schedule a call with me. I just talked to a fellow listener, Paul, the other day. It was really nice. It was a really good conversation. Just helped him answer some questions. So there's a link in the bottom if you want to do that, or you can just call me directly. I think my phone number is down there too. But how did Sarasota hit the map? Well, it's not a good one, unfortunately. Sarasota was named as the area that had the biggest price reductions in homes. So it's actually not just Sarasota, right? It's the Manatee County, Sarasota County, and Charlotte County metro area, which is a giant area. So I guess, in Southwest Florida, which is where we are, this is where the price decreases started happening because our inventory is rising. And of course, in Charlotte County, they have a little bit more problems than Sarasota County because Charlotte County had the most inventory hit the market. They literally had a 3x in the number of homes for sale. Over year. So it's been a rough ride for them, and I'm sure that whole area, including the Northport area, which is half in Charlotte County but mostly in Sarasota County, that area right there has some serious price reductions as well. And I think that area has major price reductions because of all the new construction that's happening. You see, with new construction, what the builders can do that the home sellers can't do is they can offer such incentives as upgrades, right? Then they can offer incentives as such as low interest rates. So they just buy down a large pool of mortgages for the future down to like 4.5%. And that's what your interest rate is going to be if you buy new construction. Plus, it's a new home. You're going to be so happy to have a brand new home with meeting the latest and greatest building codes. Plus, you have all the wind mitigation discounts, so your insurance is super low, and you kind of don't have to worry about getting dropped by your insurance company because there's most of the companies are going to be writing those policies, and they're not going to have an issue with a brand new home. So literally in this area, we had 48% of all listings have price reductions. Tampa was a close second. They had 44%. And Tampa's actually kind of been on fire. Like the fire kept going there a lot longer than it did here in Sarasota with this recent boom that we had. But unfortunately, most of the places that have the biggest number of price cuts are located in Florida, and they are directly related to the same metro areas that have the largest increase in inventory. For example, increases in inventory, Cape Coral had 51% increase in inventory year over year. Sarasota Bradenton had 48%, Fort Lauderdale 30%, Tampa 29%. Those are the top 4 on this top 10 list in the whole nation. But then we could go to Texas. McAllen, Texas had 25, and Orlando is the next one. Another Florida city or Florida metro area, 23% more inventory in Orlando. And then as we keep going down the list, we have Knoxville, Tennessee, Dallas, Texas, and then again, West Palm Beach, 20% more listings year over year. So obviously, as there's more listings hitting the market, then there's a lot more people who kind of have to sell. They're, I wouldn't say desperate, but some of them are. And I just had an interview recently for a listing appointment, which surprisingly I didn't get. Unfortunately, still not sold. And this was a seller that had to sell. They didn't want to keep paying the condo association dues. And I feel for them, right? Because they didn't price it where they had to price it to sell it. Not only that, but they got an agent that didn't do professional photos, didn't do a video, didn't do a Matterport scan. Look, agents, do your job. Get out there and just do the best you can for marketing the property. You are a marketing expert with a real estate license. So why would you not do a 3D scan, a Matterport scan? This is a 24/7 open house that you can provide, and you can publish that and you can promote it on Facebook. But nope, they didn't do it. They saved themselves $200. It's so silly. If this listing comes back across my desk as an expired listing, I'll let you know, because I'm pretty sure I'm gonna get it second time around. Honestly, I just think it was a commission issue. So now ask yourself, if you're gonna be buying When is the perfect time to buy? Is it as prices are falling? Is it as inventory is rising? Is it as interest rates fall? You know, there's a lot of good questions for you, and my answer is very simple. Buy when you need a house. Don't worry about the inventory. Don't worry about the interest rates. Don't worry. Just stop paying rent. That's what I say. Of course, I am a real estate agent, but real estate has been by far the best investment I have ever made in my life, over and over again. I've only had one real estate investment that lost me $1,000. That's it. And it was a flip I tried to do, and the expenses went out of control. It was also during 2012, where there weren't many buyers out there. So I'm just saying, most other investments in real estate that I've done have been fabulous and wonderful. So don't wait to buy real estate. Just buy real estate and wait.